Hello, everyone, and thank you for joining us for our financial webcast today titled Market Insights, Finding Investment Opportunities Ahead with a Q&A with Jim Holtzman. My name's Dan, the moderator for the webcast. Today's webcast presenter is Jim Holtzman, CFP, CEO, President, and Wealth Advisor of Legend Financial Advisors. Please hold as I turn it over to Jim.
Okay, thank you everybody for joining us today. So there is a big meeting coming up with the Federal Reserve, and that's where we're going to start with today. So the Federal Reserve is going to have a meeting coming up on December 13th and 14th, and on the 14th is the big announcement day when they talk about how much of an interest rate increase they are going to make. So the last four meetings have been 0.75% each meeting, and that's the most aggressive interest rate increase we have seen since the 80s when we had really high inflation. And it is expected that for this upcoming meeting that the interest rate increase is going to be 0.5%, so a little lower than it has been. It's not ruled out that it could be another 0.75%, but the expectation is that it will be 0.5%. So that'll be something to watch out for. That would be a sign that at least the Federal Reserve feels they can take somewhat of the foot off the gas pedal for bumping up interest rates as aggressively as they have been. So as the Federal Reserve is doing this, their goal and objective is to tame down inflation. And the problem becomes is that inflation, we're dealing with it today, but there's a lag typically of about 6 to 8 months where it takes, that's how long it takes for these interest rate increases to filter through the economy. So the Federal Reserve is doing these rate increases not really knowing what the impact will be once it goes all the way through. So that's what makes these situations so tricky. This is why the market watches this so much and tries to get a kind of a heads up on where the Federal Reserve is moving to. So right now, the interest rate is for the federal funds rate, which is the rate they control, is between 3.75 and 4%. So the market is currently projecting that we're going to land at between 5 and 5.25%. You'll hear that the terminology is called the terminal rate, but basically that's going to be the rate where the Federal Reserve stops increasing this interest rate. So the labor market is still very strong. Some of the other economic numbers have been starting to slow down. So that could be the result of the impact of the interest rate increases that have already occurred. But this will be a big meeting coming up next week. It will get a lot of headlines. But that expectation is it'll be a 0.5% increase. And we'll talk about CDs and kind of other rates that it will increase alongside of it. So this is a graph, and the main thing to show, we're going to look at the top half of this. And so the blue line, light blue line here, is the federal funds rate. So this is the technical name of the interest rate that the Fed moves whenever they have these meetings. And so the red line is the CPI year-over-year change. So what you can see here is that we got 2022 and 2023, and then we have 2021 back here. Well, you can see as the year progressed last year, those year-over-year CPI numbers became very high, and that was big news, big headline news, and you can see it peaked basically right around here in the second quarter of 2022 at about 9% year over year. So what you will also notice that if you look at how these year over year increases were happening, the Fed funds rate was staying the same. They kept it at zero until we got to the first quarter of 2022. And that's one of the problems you could say that is occurring is that the Federal Reserve reacted very late and now they're catching up. And then we'll have to see if there's any consequences, negative consequences of raising rates so quickly, so much. So as we kind of move through this chart, you can see the Fed funds rate does continue to go up. And then what we're looking at as we go in towards next year is that you can see the line is still going up, but then it starts to level off around the second quarter of 2023. So that 5 to 5.25% interest rate, that's expected to be achieved at this point. But the data is really going to lay out what the Federal Reserve does, and this could change. And then you can see the year-over-year CPI numbers are starting to go down. Now, this chart was prepared in the middle of this year. But I like the way it reflected kind of the change in the year-over-year rate. And this is pretty much what we've been seeing. The dotted lines are really meant to be projected, but in the same thing for the blue. The dotted blue lines are the projected rates. We're already past some of this, but this is pretty much what we're seeing. And the CPI year-over-year number continues to decrease, and you can see they sort of cross over on their percentages around the second quarter of 2023, and the year-over-year number is still expected to go down. So that'll be at least what the projection is right now. It's a pretty good consensus that that's sort of the direction we'll take. The specifics we'll have to wait and find out. So let's talk about CDs. And with interest rates going up, so the Federal Reserve, they move that federal funds rate, and then there's a lot of other interest rates that are sort of benchmarked against it or tagged against it. So as the Federal Reserve moves rates, you will see different rates go up. It could be everything from a CD to a money market to a mortgage rate. So the question comes up a lot about, do CDs make sense at this point? There are some advantages of a CD. As long as you're with the bank that has FDIC insurance, you'll have coverage with that, provided you stay under the limits. You certainly get a predictable return, and you'll get typically a higher return than, say, a savings account or a checking account, a money market fund sometimes, because you're locking up your money for a period of time, so you should be rewarded with a higher interest rate. So another advantage could be that, say, you have a goal of buying something in, let's just say, 2 years. You could get a 2-year CD, lock it in, and have that CD mature at the time you want to meet your goal. That kind of help you not use that money for something else, because you can have withdrawal penalties, early withdrawal penalties. So, there are some definite advantages to it. And as I mentioned before, it's going to be a higher rate than a savings account, checking account. Disadvantages is that the CD is going to be less liquid than a savings account. You do have those early withdrawal penalties, and that'll just depend on the bank itself in terms of how steep the penalty could be. Sometimes it could be 1 year's worth of interest. So you got to be really careful before you move into the CD to understand those terms. Disadvantage can be clearly if you would be locking in a lower interest rate if interest rates keep rising. So if you use sort of an extreme example, say 12 months ago, you locked in a 5-year CD, probably would have paid 1 to 1.5%. And then you look at where interest rates are now. Well, interest rates have gone up quite a bit. Inflation has really taken off. So that would be a problem. So looking at today, if you were to get, say, a 5-year interest rate or a 2-year interest rate, we're going to see interest rates most likely keep rising with the Federal Reserve. So you could make the case that locking in today, while it would be better than locking in a year ago, you would want to be careful and understand that the interest rate could go up. And the whole reason why that is happening is due to inflation risk. So rates on CDs, no matter how far out you go in the term, they are still behind inflation. And so this is really one of the main objectives with your money, is to be able to beat inflation. So you want to be careful how you navigate through that. So ultimately, do they make sense or not? So they're not great to use during an inflationary environment. So I would say not yet at this time, unless you're getting some terrific intro rate or some kind of terrific rate from your bank. The other problem that we're seeing is that, or not really a problem, but it doesn't justify using CDs, is that when you look at certain money market rates and you compare them to CDs, the difference in the rates are not very large to justify locking up your money for, say, 2 or 5 years. We were recently able to take advantage of a money market fund for our clients where we're able to get a current yield of 3.79%. Well, if you look at a 5-year CD, typically the rate's between 4.2, 4.5%. And with interest rates still rising, we know that the money market rate will also continue to rise, maybe not step for step or rate for rate that the Federal Reserve moves, but it'll go up pretty respectably, where the CD rate you'll be locked in if you buy it today. So, and then if you're really hard set on using CDs right now, you can consider using what I call a CD laddering strategy, and that would be where, let's say you have $30,000 you want to put in CDs. Well, you could put in just, say, $10,000 today, wait another, say, 6 months, and then if interest rates are higher, you could put in another $10,000, maybe wait another 6 months to see if the interest rate environment continues to rise. That way you're sort of spreading the risk, and then you have the CDs coming due, at basically like once a year. So you can set it up that way. You can start with a 1 year, go and out of a 2 year CD, 3, 4, and 5, for example. So there's different ways you can do it. This at least helps protect you from the inflation risk and the risk of interest rates going up. So now we're going to talk about the length of bear markets. This has been receiving a lot of attention recently, given how the markets have been performing. So a couple of just interesting facts. There have been 21 bear markets since 1928. So a bear market is going to be a high to low of 20%, so a 20% drop in the market. The average length has been 388 days. The longest bear market was 929 days, and that was the 2000 to 2002 downturn. The shortest one is 33 days, and that was the downturn that occurred during COVID in 2020. If you recall, the market peaked in, like, say, mid-February and then hit a low towards the end of March and then took off like a rocket from there. So this was the shortest downturn we had ever seen for a bear market. Now, the 2022 bear market start was January 3rd. So we're, 11, 12 months going into this current bear market. So if you look at the average, we're still not there yet. So that's something to at least be cognizant of. It just feels like a very long time frame, and it is going through the entire year like this. But when you kind of look at it historically, we're currently right around the averages for the average length of a bear market. This slide's a little bit hard to read, but it gives you a breakdown of some bear markets that have occurred in history. So the way you can read this is that the first one, the peak was, and this is for the Great Depression, was September of 1929. The trough, or the low point, was June of 1932. And yes, this was an 86.2% decline at that time. The recovery, so it took March of 1937 as far as recovering. And then the event is listed in the last column. So it's the crash of 1929. There were really two parts of the Great Recession. And then the second period is right here. So March of 37 to April of 42, another 60% decline. And then that recovery, it took until May of 1946. So this gives a little bit of a history lesson. It's a little kind of jumbled together, but this is really interesting data as far as the type of declines we see and the way this is broken out. It goes from the worst decline to the, I'll say, least decline of 20%, and the reasonings for those declines. And right here is the, I'll call it the COVID decline. And so you can see where that ranks historically, kind of right in the middle from a high to a low standpoint. This is a very high, this is the biggest percentage drop in basically a 30-day or 33-day period we'd ever seen. Even in the Great Depression, the drop over a 33-day time frame, you can't find one that was basically close to, or that was about 34%. So just putting some of this into perspective. This next chart is kind of interesting. It covers bear markets since 1956, and it's just a different way to illustrate it. So I'll walk you through, let's go through the March 2020 downturn, and that was the beginning of the tech crash from 2000 to 2002. So the way you want to read this is going to be in the dark blue is going to be the length of the bear market, and in this case it was 31 months. The light blue line is that high to low. So for the S&P 500, that was 49%. And then it has the recovery, the number of months, and that was 56 months. So you're looking at a really long time frame as far as getting back for the S&P 500 back to break even. And so that's the way you want to read this. And then you can look at just looking at some of the more recent ones. The 07-09 financial crisis period, the length was 17 months for the bear market. It was almost a 57% drop. And then the recovery was 49 months. And part of this is why it's called the lost decade for investing from 2000 to 2010, because you had these two incredibly sharp drops occurring over that 10-year time frame. And then you can see it's kind of interesting looking at the COVID decline. So basically a 1 month drop 33.9% drop percentage-wise, and then 5 months as far as the length of recovery. So unbelievably quick from that standpoint. So now we'll talk about a bear market rally. So this term has been making its way into the news headlines more and more this year. So what exactly is a bear market rally? So the best way to put it is going to be it's a period of time where the markets are running, they're doing really well, and everybody gets optimistic over that time frame because you just went through a pretty good downturn. However, these type of a bear market rally occurs during or in the middle of a bear market. The problem with the bear market rally is that after the markets run up, then the market drops lower than it was before. And I'll show you a chart on the next couple of slides that'll help illustrate this a little better. So basically, you have a low point, you have a run up, and then a market drops off lower than that first low point. It's like kind of like a set of steps going down. So just a point of interest is that every bear market since 1900 has had at least a rally of 5% or more before declining to its ultimate bottom. So it's not unusual to have these rallies over these time frames. So what I'm going to show you next is going to be the last 3 downturns and bear markets and some of the rallies that occurred. So this one covers the 2000 to 2002 period. So we start off, the S&P's way up here. You can see that we had a beginning drop of about 11%. Then the markets rallied 12%, basically getting very close to break even at the very beginning of this period. And then the markets went into a fall. And you could say this is also maybe a small bear market rally, but basically from here to here was a 27% drop. Then the markets rallied up 19%. That's a pretty significant bounce. So if you're living in that moment and the markets are rallying, you could feel, and I'm sure you did, felt really good during this period of time. However, we weren't done with the bear market. So the market then dropped another 26% from that temporary peak. And then we had a period where the markets ran up 21%. So again, that probably felt really good. And you can see this is over a shorter time frame, or a pretty short time frame in line with the last bear market rally. Then the markets fell 8%, and then he rallied back 8%. But then the really big drop started to occur in 2002, where we had a 32% drop from that high point. The market rallied 21%, then fell back 19%, bouncing up 21%, and then finally reaching the low point by dropping another 15%. It was a little bit higher than its ultimate low point, but you can kind of get the picture with these bear market rallies. So that's where all the plus numbers are showing up. Those are rallies where it felt very good to be at least on a better road than falling down. But all that happened was the market fell off for the most part to a lower bottom. So if you kind of take a step back at this, it is sort of like a set of steps. And you just keep going down those steps until you reach the bottom. And then, of course, you have the great part is that the markets did recover very nicely. It took about 5 years for that to happen. But at least at this point, the markets were hitting the low point. So if we go to 2007 through 2009, so the peak of the market was October 9th of 07, the low point was March 9 of 09, it's going to look somewhat similar to the 2000 and 2002 period. So we have a high reached here, and then we have a low, the current temporary low, then a rally of 3.7%, not a big issue, and then the markets fell off, and I don't have the percentages exactly as far as how down that dropped. The market rallied 8.1%, and then you can see a much steeper drop occurred. Then you have a rally of 6.5%. Then another drop that occurred about to the same low point we had, and then the market rallied 13%. And this occurred over 69 days. So you're talking 2 months, and that feels very good. However, we're not done yet. Then the markets went into another drop. A new low is reached, and you can see that just by drawing somewhat of a straight line across. And then the markets rallied up another 8%, and then they fell off here, and then we had a rally of 6.5%. Big drop occurring here, but then it bounced 15%. Another drop, 18.7% rally, then another drop with a 24% rally. Now, that probably really felt like we were getting to the end because of how long this bear market lasted for, but weren't quite done yet. And you can see there was another kind of temporary drop, another rally of 8.8%, and then a final fall off where we hit the low on March 9th of 09. So again, kind of a step pattern. You just keep going down the steps. And this, again, is not unusual to see in a bear market. So now we'll show you the current situation. I didn't even bring up the COVID downturn because that was such a quick bounce or drop and then a bounce back. And so this shows you the S&P 500 for this year. That's the blue line. This orange line is a 200-day moving average. It's interesting because when the S&P 500 goes above or falls below this particular line, that can be a good indication that the market is ready to move forward in case it moves over the line, and then the opposite if it moves below the line. So the main part there is just to show some of the bear market rallies we've seen this year. So at the beginning of the year, we had the drop off towards February. We did have a bounce back that occurred, and then the war started in Ukraine. That pushed the markets back down, and then the markets did rally not long after the war started. But then you can see we had another drop off, a little bit of a rally, another drop, and then towards the middle of the year, the market had a pretty nice rally going, around June, May to June. Then it really fell off at the beginning of June. And then from around mid-June to mid-August, the market rallied. This was about a 20% bump up. This felt really good. And then all of a sudden, the market went through another leg down. It did bounce quickly here, but then it dropped off again when we get into October. And you can see we're now at a new low at this point for the S&P 500. Quick rally, another drop down, even a little bit lower. And then we have at least started to maybe make our way up, but we're not necessarily out of the woods yet. So another rally here, a small drop, another rally. And then we're basically at this point in time, the concern would be is that if this blue line crosses over or below the 200-day moving average, so we're going to have to wait and see where we exactly sit with this. But if you see again, this sort of step pattern, very similar to what we were reviewing on the last couple of slides. I think the main takeaway here is that what we've seen this year is not that unusual when you look back historically during these longer bear market periods. So it's something in our investment committee meetings we talk about constantly whenever the markets are rallying. Is this going to be another bear market rally? What's going to happen with it? And there's no way to ultimately know. But I think the main takeaway is during these periods, you don't want to get kind of drawn in to the bear market rally. It's very hard to time these cycles, as you can see. So just because the market starts rallying, say in this period, you don't want to just jump in if you went to cash or maybe put a decent amount of your money in the cash and you wrote some of this down, and then you kind of wait to see if this market rally is going to hold. Maybe you buy in around here, but all of a sudden you'll get a little bit of an upturn, but then you meet the next downturn. So this, again, is not unusual, these type of movement patterns, and it's something we're keeping a close eye on, but also being skeptical of these rallies we've seen recently because it's just not out of the ordinary for it to happen. So with all of this negativity in the markets this year, there are some things that you can do that help improve your overall investments, your overall financial situation. One of those is tax loss harvesting. So what do we mean by that? We're talking about recognizing capital losses on investments that are in a taxable account. You hear the term tax loss harvesting. So when you're recognizing a capital loss, you can write those off completely against your capital gains if you have incurred any. And then above and beyond that, if you fully offset your capital gains, you can write off $3,000 against ordinary income, like wages, interest, or dividends, for example. If you have losses beyond that, you can carry that forward to future years. So the tough part about a year like this year is that at the beginning of the year, we were looking across our portfolios. We had a lot of really nice gains and a lot of investments And we realized, though, that the market looked like it was getting towards a peak. We wanted to take some of the gains off the table, and we did recognize capital gains early on this year. So, of course, then the market fell apart as the year moved on, as we showed in the chart for this year for the S&P 500. But it kind of creates a situation where you can't avoid being down to a degree in a year like this. Then you have capital gains on top of that. So we've been, as the years progressed, we've continued to look for opportunities where there could be capital losses to offset against those capital gains. And we've been able to do that successfully a couple of times this year. So we improved our client's tax situation, and then we did it in a way that we weren't hurting the investment positioning. And so one of the things you have to be concerned about, or at least aware of, I should say, with a capital loss, is there's a rule called the wash sell rule. And that means if you recognize an investment, sell the investment at a capital loss, you cannot purchase that same investment within a period of 31 days. You need to be out of that investment for that period of time to recognize the capital loss. Now, you can take those proceeds and invest in something else or something that is similar in strategy to what you already sold. And that way you don't remove the market exposure. So we were able to do that earlier, about a month ago maybe, for our clients. And that worked out really well because we were able to lock in a capital loss, and then we immediately had the funds reinvested into something similar. And that investment did really well initially. Now it's fallen off with the markets, but we at least removed the issue of having the money in cash for a 31-day period, kept the money invested, and we're still able to recognize the capital loss. So we continue to do that as we head towards year end, but it's something that's really important because in a year like this, you want to at least try to mitigate those capital gains as much as possible. So when you're recognizing capital gains, if it's short term or the holding period is 1 year or less, the tax rate is going to be at your ordinary tax bracket. So that could be anywhere from basically 10 to 37%. So when we go through this, now we're looking at recognizing capital losses, but also in terms of the gains we've recognized earlier this year, we try our best to get to the 1 year period because you get the long-term capital gains rate. And you can see these are the ordinary tax brackets. If you're in the 10 and 12% bracket, you would have 0% for your long-term capital gains rate. And then you have 15% from 22 to 35%. Then if you're in the top bracket, you do have a 20% cap, long-term capital gains tax rate. So you can see it's more favorable. And then, of course, if we can offset it with capital losses, then you're in a much better place tax-wise. And I just put an example in here just to illustrate kind of numerically. So we have investment A. It has a $50,000 capital gain. So if you were to go ahead and sell it, you would have a tax of $20,400. And that's figured out by taking the $50,000, taking the top rate of 37%, plus 3.8% for the additional Medicare tax if your income is over $250,000 if you're married filing joint. That's where this number comes from. So that tax bill would be $20,400. So over here we have investment B that has a $75,000 capital loss. So if that is taken, then it's able to offset completely the $50,000 capital gain, and basically you're saving $20,400 in taxes. Then you apply the $3,000 to reduce ordinary income, which would save you another $1,224, just simply taking that number of $3,000 times 40.8%. And then that remaining $22,000, so the 75 minus 50 minus 3, is able to be applied to offset capital gains in the future. So it's just things like that that can make a big difference. We spent a lot of time going through this for our clients. You do want to do all of these moves while still thinking about the portfolio, though. That's the most important issue to consider, which is why in at least the one case, we had the money invested immediately because we didn't want to be out of the market at that period of time. That turned out to be a good move while still recognizing the capital loss. So you have to be careful how you navigate through it, but it is important to try to take advantage of those situations whenever they do come up. So with that, I am able to take questions and answers. I know, in terms of the themes and, what are those investment opportunities, going forward, what we've been doing, with our clients' portfolios, we've been very comfortable with how the portfolios are allocated. We've made a number of changes this year to deal with the current environment and opportunities in a rising interest rate environment. We've adjusted our clients' bonds positions pretty significantly this year. We have taken the gains off the table from a lot of investments earlier this year, replaced them with much or less expensive investments that have held up much better during this downturn. And what we like about that strategy has been we've been able to keep our clients invested because you saw those charts, they're all over the place when the peaks and the valleys hit. And we can't time that. We don't know when the next rally or the next downturn will be. But if we have a really good sound investment strategy for our clients, then we're able to keep our clients invested while mitigating the losses and allowing for the recoveries to occur. We're still carrying more cash than we typically carry for our clients, so that helps buffer some of these downturns as well. And then we did switch our clients over to a money market fund paying that 3.79% that I talked about before. So what we're trying to do during a tough year is find wins along the way. Getting that money market rate is a win. Taking some of the capital losses, at least from a tax side, is a win during a tough year. And just making the changes we think are necessary. So with that, I'll take any questions and answers that anybody has. And we will send out a replay of the webcast, and there are PDFs of the handouts that are part of this. And then we'll send out a link and an update whenever we do have this webcast posted. So one question in regard to just some of the kind of structural changes we made this year. So one of the areas that we wanted to reduce for our client portfolios was a style of investing called growth investing. So over the last 5 years or so, growth investing, and really over the last 12 years, growth investing has done very well. Growth investing does well when interest rates are really low or heading lower. Technology is a really good example of the type of investment that does well. So those had really large gains, and we wanted to certainly take advantage of that while the situation occurred, which we were able to do. And then when interest rates start to rise, the growth investing will typically not do well, which is what we've seen this year. And another style of investing called value investing will typically do well or do better. So we're able to shift, taking gains from the expensive areas of the portfolio, move them into less expensive areas. So it has more cushion on the way down, but also better return potential moving forward. So along with that, we've had different, I'll call it non-correlated investments in the portfolio, from commodities to gold. We added managed futures. That's a different asset class to the mix. And then we added another asset class called merger arbitrage later in the year. And all of those moves are able to mitigate the risk without necessarily harming the longer-term potential return. A couple of those strategies take advantage of higher interest rates. So it's been quite a while since we've been able to use managed futures and the merger arbitrage strategies. We had used them in the mid-2000s when rates were higher. But it's really been that long since we've had a good opportunity to use them. So it's really nice to include those in our client portfolios because they help mitigate risk, mitigate the volatility without hurting necessarily the longer-term returns. So a question came in, and when the Fed signals they are done raising rates, how will that change your plans? It's a really good question because we're probably going to hit that point, we'll say the first quarter of next year, unless things change dramatically. And so at that point, the Federal Reserve has indicated that they are not just going to simply start lowering rates at that point. They're probably going to leave them steady for a period of time. So some of the things that we've done this year is rates have gone up. We've seen some really big spikes in interest rates, like mortgage rates, for example. And we've had two different bigger spikes this year. When those happen, we bought more traditional bonds in our client portfolios because the interest rates were really at a really nice entry point, where we avoided traditional bonds all for really quite some time, especially this year. Traditional bonds have not done well with the rise in interest rates. They've done terrible, actually. And when I say a traditional bond, that means a bond that pays a fixed interest rate. So when we hit those peaks, we were able to take advantage of that. So when the Fed signals they are done raising interest rates, that could be another good opportunity to look at putting a more traditional bond into the portfolio, because rates will be at an attractive entry point. So that's one thing that we would consider doing, at that point in time for bond purposes. And then for equity purposes, if we are at that point, then maybe it makes some sense at that time to maybe reduce some of our value exposure from the portfolio, because the next move would probably be downward for interest rates. So it would be an opportunity for us to look at where maybe there are some gains that have accrued, take those gains, reallocate them to an area of the market that could do better if rates start to fall off. But I think there will be a period of time, probably a good part of next year, if we do hit a topping point on interest rates, where rates will probably stay the same. Hey, another question is, will value still be good for next year? So we believe it will be for 2023. Certainly as interest rates continue to go up, that will help value investing. And then again, if rates plateau, let's say for the rest of the year, that could be, again, a good point for value to still perform well. But we would be internally starting to discuss maybe reducing that allocation somewhat, because of the possible next move being down in interest rates, which wouldn't bode as well for value investing. We'll just really have to reassess it when we get to those different points, see where the valuations are for value investing, and make a determination at that point. We probably would not be adding to value at that point in time, given where we would be in the interest rate cycle. And just one other thing I'll mention, I've mentioned before in our webcast, is that just remember that the market is a leading indicator. So it typically will lead ahead of the economy by about 6 to 8 months. And thinking about where we are in the market cycle, so we've had a really rough year this year for the markets. So the market has fell for the first 6 months of the year, really all year. But thinking about the first 6 months of the year, the market fell off, and the economy was still chugging along. That was the whole point of why inflation has been increasing and why the Federal Reserve has been raising interest rates. So it kind of didn't make sense. The market would be doing poorly while the economy was doing so well. But what the market was looking at was forecasting interest rate increases and a slowdown in the economy, which is really where we are at this point, is seeing some of those repercussions of interest rates going up, with some economic indicators going down. But the economy is still doing okay. But we've seen at least a couple of pretty decent rallies over the last few months in terms of where the markets are. And if we're going to be maybe somewhat closer to being out of this really rough year and how the markets are performing, we could be at a point where the markets do start to turn in a more of an upward fashion. But the economy, or the economic numbers and the news headlines, are going to be probably getting worse. So, but the markets might be ahead of that point. That's typically what happens. And so when you think about investing, and I'll hear the term, well, I want to wait till things get better. Well, the problem with that is that when the economic news gets better, the market usually has already taken off. And so you just have to be cognizant of that as far as what your trigger is for investing, maybe money that's in cash if you sold on the way down, things like that. Just the markets have always been a leading indicator, and just something to be cognizant of. Another question has to do with gold. Seems to have stalled, and what the reasons could be for that. And that's a really good question, because you hear about gold being a great inflation hedge, which historically it has shown. And here we are with higher inflation than we've seen in a really long time frame. But gold is actually down for the year. So the problem right now with why gold is not doing well is that gold also moves inverse to the U.S. dollar. So with interest rates going up this year by the Federal Reserve, that has made, all things equal, the US dollar very attractive for, say, international investors, because our rates are much higher, the dollar is much higher as a result of that. And so with that inverse relationship from the dollar to gold, gold has been going down because of the dollar rising. When we get to an end point with that, which would be, probably at a point where the Fed stops raising rates or other countries are raising rates quicker, then we would expect to see more of the traditional gold being a good hedge against inflation. It's just been a rough go this year because of how fast rates have gone up and how much the dollar has increased in value. So we think it's going to be a temporary thing until we kind of level off a little more with rates, but we will have to see. Okay, I'll hang in there a few more seconds to see if there are any other questions. And obviously, we're happy to talk about this further. If anybody has any specific questions, we can easily do that and talk about your situation a little bit further. So with that, I think that's going to do it, but I really appreciate everybody making time for this. We're going to try to keep doing these on a consistent basis as the markets change quite a bit very quickly these days. So I'm going to turn it back over to Dan.
Great, thank you, Jim, for a good summary of the information today, and I want to thank everybody for joining us for the webcast. If you'd like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending the webcast, and this concludes the event.